Hello and welcome to another module in the financial accounting course. In this lesson, we're going to be learning about recording transactions, the different ways of recording transactions, ledger and trial balance, adjusting entries, and closing processes. So starting with recording transactions, what is recording transactions? Recording transactions in accounting is a foundational process in financial accounting where all business activities involving money are documented systematically. Recording transactions involves documenting all financial activities of a business to ensure accurate tracking of its financial performance and position. There are three major methods for recording transactions, and they are the double entry bookkeeping method, debit and credit, and journal entries. So we'll be starting with the double entry bookkeeping. Double entry accounting is a method where each transaction requires debiting one account and crediting another. Double entry is a bookkeeping and accounting method which states that every financial transaction has equal and opposite effects in at least two different accounts. In accounting, a credit is an entry that increases a liability account or decreases an asset account. A debit is the opposite. It is an entry that increases an asset account or decreases a liability account. In the double entry accounting system, transactions are recorded in terms of debits and credits. Since a debit in one account offsets a credit in another, the sum of all debits must equal the sum of all credits. The double entry system of bookkeeping standardizes the accounting process and improves the accuracy of prepared financial statements, allowing for improved detection of errors. Now we'll be moving on to debits and credits. Debits and credits are essential to the double entry system. In accounting, debit refers to an entry on the left side of an account's ledger, and credit refers to an entry on the right side of an account's ledger. To be in balance, the total of debits and credits for a transaction must be equal. Debits do not always equate to increases, and credits do not always equate to decreases. A debit may increase one account while decreasing another. For example, a debit increases an asset account but decreases liability and equity account, which supports the general accounting equation of assets equals liability plus equity. On the income statements, debits increase the balances in the expense and loss accounts, while credits decreases their balances. Debits decreases revenue account balances, while credit increases their balances. Now we'll be moving on to journal entries. A journal entry is a record of financial transactions in an accounting system. It specifies the date, accounts involved, and amounts to be debited and credited, ensuring that debits equal credits. Each entry also includes a brief description of the transaction, maintaining accurate and traceable financial records. In a double entry bookkeeping system where every financial transaction must have a debit with a corresponding credit in at least two different accounts, a journal entry records the details of debits, credits, and accounts affected. A journal entry must include a transaction date, the names of the accounts impacted by the transactions, plus the account numbers if applicable, the amount debited, the amount credited, and a brief description of the transaction. It can also include reference numbers depending on the business and record keeping needs. Now we'll be moving on to ledger balance. A ledger is a book that contains records of all the transactions related to a particular account within a financial year. It also is known as the principal book of accounts, and the combination of all the individual ledger accounts is known as a general ledger. The ledger accounts include accounts for different types of fixed and current assets, revenue and expenses, liabilities, gains, and losses. We also have the trial balance, which is a statement that gives a report of the financial debit or credit balances of all ledger accounts in an organization. A company prepares the trial balance at the end of the financial year. It is used to prepare financial statements like the balance sheet and the profit and loss account. It helps to ascertain the mathematical accuracy of the financial transactions recorded in the ledger accounts of a business. Now, let's quickly look at the differences between a trial and ledger balance. There are different aspects in which we can look at these differences. One is in the definition, in the hierarchy within accounting, and in its format. So, a ledger is an account-wide summary of the business transactions recorded in the journal. A trial balance is a statement prepared at the end of the financial year to depict the debit or credit balances of all ledger accounts. The ledger is also known as the principal book of accounts. It gets prepared after the financial transactions of a business are recorded in a journal, while the trial balance is prepared only after ascertaining the debit or credit within all the ledger accounts. Thirdly, all ledger accounts are prepared in the T format, with the debit transactions posted on the left column and credit transactions on the right column. In a trial balance, the document is prepared in a columnar format with separate columns for posting the debit and credit balance of ledger accounts. There are actually many differences between ledger and trial balance, but both of them are essentially for preparing the financial statement of any business, and they are an integral part of the double entry bookkeeping system, and the accountant needs to prepare them without any errors. Otherwise, the books will not reveal the actual financial position of the firm to its stakeholders. Now we're going to look at the next subtopic, which is adjusting entries and closing processes. Generally accepted accounting principles, GAAP, requires businesses to recognize revenue when it is earned and expenses as they are incurred. Often, however, the time of a payment may differ from when it is received or an expense is made, so accrual and deferral methods are used to adhere to accounting principles. Accrual basis in accounting is generally considered the standard way to do accounting. The Security and Exchange Commission requires all public companies to use accrual basis accounting and comply with GAAP to provide consistency and transparency of reporting for investors and creditors to evaluate business. So what's the difference between the accrual method and the deferral method in accounting? We will explore both methods and walk through some examples, or at least the examples will be in the document of the lesson note. So accruals are when payment happens after a good or service is delivered, whereas deferrals are when payment happens before a good or service is delivered. An accrual will pull a current transaction into the current accounting period, but a deferral will push a transaction into the following period. What are the key differences between accrual and deferral method? We want to look at them in the aspects of timing, expenses, payment, revenue. So with respect to timing, in the accrual method, items occur before payment and receipt, while in the deferral method, it occurs after payment or receipt of revenue. With regard to expense, in the accrual method, expenses are incurred but have yet to be paid. In the deferral method, expenses are paid but have yet to incur the expenses, such as prepaid accounts. With regard to payment, in the accrual method, there is no payment of cash, but in the deferral method, there's an advance payment of cash. With regard to revenue, in the accrual method, revenue is earned but has not yet been received. But in the deferral method, revenue is received but has not yet been incurred. An accrual system recognizes revenue in the income statement before it is received. A deferral system aims to decrease the debit account and credit the revenue account. Now, we'll be looking at the importance of accruals and deferrals. Accrual and deferral methods keep revenue and expenses in sync. That's what makes them important. In accounting, deferrals and accruals are essential in properly matching revenue and expenses. Using these methods consistently helps someone looking at a balance sheet understand the financial health of an organization during the accounting period. It also helps company owners and managers measure and analyze operations and understand financial obligations and revenues. By using these methods and following the generally acceptable accounting principles, investors and other stakeholders are also able to better evaluate a company's financial health and compare performance against competitors. The key benefit of accruals and deferrals is that revenue and expense will align so that businesses can account for all expenses and revenue during an accounting period. If businesses only recorded transactions when revenue is received or payments are made, they will not have an accurate picture of what they owe and what customers owe them. And so this method of accounting also tends to smooth out earnings over time. And with that, we have come to the end of this lesson. In the next lesson, we will be looking at income statements. Thank you very much for watching this video. Bye for now.